Hi, I'm David Stein of Money for the Rest of Us. This is a channel on money, investing in the economy, and today we're going to look at whether the U.S. housing market is going to crash in 2021 or 2022. Is that a risk we should be concerned about? We need to look at the data and look at what drives home price appreciation. We've had an absolutely amazing run of home prices, where in the U.S. they've increased close to 20% over the past year. So we want to look at the data to understand what are the risks. Is it really possible? Let's start by looking at the actual price appreciation. This is 3-month annualized through the end of August and 12-month. And you can see it's close to 20%. We can look at different measures. The National Association of Realtors shows that prices increased about 17.8%. Case-Shiller, 18.5% year over year. The Federal House Finance Agency, 10%. Even the median home price has increased dramatically. You can see that it has spiked over the past year. As the economy opened up, when the pandemic became a little less severe, people realized they needed a bigger house. We saw that in our life. We had a house in Phoenix. We had all our kids home trying to study online. It was too small. So we bought a house in Tucson last year. What we need to understand about home prices, it's driven by supply and demand. This particular chart, we can look at the median home price increase, and you can see again that spike. But look at the red line. That's the number of months supply of homes available. And it has been dropping since 2010. There isn't a lot of supply right now when it comes to homes, and that, depending on the demand, can push up the price. Look at when the housing market crashed back in 2006, 2007. You see the huge amount of inventory at that particular time. We can also look at it in a scatter plot. This looks at the median price of houses and the month's supply available. The more months of supply there is, the more houses there are to buy, the lower the median price. Whereas some of the data that we're seeing now up in the top left, you got the prices increasing because there isn't as much supply of houses available because a lot of people want a house. There's that fear of missing out. Let's take a look at the number of new homes being built. This is building permits and new home sales. Look at how many houses were being built in the 2005-2006 period at the peak of the bubble. Then inventory of new homes crashed, new permits, and we've seen an increase gradually over the past 10 years, but still it's not even close to where it was back in 2005. Let's take a look at another potential supply. As an individual, you can rent or you can buy. And if there's a lot of rental properties available, then that can push some downward pressure on home prices. But you can see there's not a whole lot of vacancy right now. There was a lot more vacancy of houses, empty houses and apartments back in 2009, 2010 following the Great Recession. But now that's not a huge concern because there isn't a lot of vacant houses. We can also look at the potential for foreclosures due to delinquencies. The blue line shows the 30-year mortgage rate, but the orange line shows delinquencies in residential mortgages. They certainly spiked with the pandemic, but they've actually come down, and they're not anywhere near like they were back in 2009, 2010. Now, that's the supply. There is a limited amount supply of houses. There's not a lot of vacant houses. They're building new houses, but the month's supply is just a couple months. Much less supply, but we also want to look at demand. And one big component of demand is, can people afford houses? And we've seen that the price of houses relative to income have increased. That's the orange line. But it hasn't increased anywhere like it was back in 2005, 2006. If we look at it from the percent that a typical homeowner is paying for their mortgage as a percent of their disposable income, that has consistently dropped over the past 10 years, and it's the lowest it's been since 1990. U.S. home prices, the mortgage service cost, which is what is the biggest part of actually purchasing the house, making that monthly mortgage, it's the cheapest that it's ever been relative to the amount of income that homeowners have. And so that is pushing demand because mortgage rates have fallen, and it's made it more affordable to purchase a house and service that debt. The overall amount of mortgage debt is also not anywhere near its all-time high. That all-time high was 2008, 2009. Now we've seen an increase, but again, the amount of debt outstanding was not like it was back in 2005, 2006, where so many people were taking out 2, 3 mortgages. There were no income mortgages. It is so much more difficult to get a mortgage today than it was 10 years ago or 15 years ago. Believe me, it took us 6 months to get a mortgage on our house in Tucson. Now I'm self-employed. With the pandemic, they made the rules more difficult, but it's not easy. You cannot lie to get a mortgage anymore. And so it's just much more difficult. Number of mortgages are going up, but the mortgage rates are incredibly cheap. 30-year mortgage rates, 3%. That's what we were able to lock in for our mortgage. Now, if you're looking for a house, it's a tough market. It's a hot housing market. And I have a podcast episode 317. We looked at that. How to buy a home in a hot housing market. This talks about the experience that we had selling that home in Phoenix, trying to buy one in Tucson. And there's tips that you can use to find a home. The bottom line is when we think about will home prices crash, possible, but you need way, way more supply and much less demand. Now, if mortgage rates spike, making it more difficult for new homeowners to service the debt, then, well, that's a possibility. But I don't see anything on the horizon in the next year or two to suggest that the supply of houses is going to be that much greater and there's ongoing demand. You have an entire generation of millennials that now want to buy a house. Now, will houses continue to appreciate at 20% a year? No. Hopefully we'll see a slowdown of the house price appreciation, but I don't see a big drop off over the next year or two. So, hey, if you like this video, go ahead and give it a thumbs up and subscribe to the channel. Check out the podcast at moneyfortherestofus.com. Check out how to buy a house in a very, very hot housing market. And if you're looking, good luck. And I'll continue to update as the housing market evolves. Thanks.